So what's the difference between a collateral and a conventional mortgage? In today's video, I'm going to be going over the differences between a collateral charge and a conventional charge mortgage and which one might be best for you. Welcome back, guys. It's Tom here from Off Mortgages. Happy to have you again, and as always, feel free to like the video down below and hit subscribe. That way we can grow the channel together and more people like you can view this. So the topic of collateral versus conventional mortgages is, in my opinion, something that's overlooked quite often, but it shouldn't be that way because it's something that's very important when it comes to deciding what type of mortgage charge you need. It's not uncommon for me to see either second or third time home buyers come to me having no idea what the differences is between the two mortgages. Now, it's no fault to the clients for not knowing the differences between the two types of mortgages. It's actually the fault to the person, whoever they dealt with in the past for their previous mortgages, because he or she didn't take the time to simply educate the clients in making that educated decision. So let's start out by explaining what a conventional mortgage is. A conventional mortgage is a standard charge that is no more than the amount that you're borrowing. So for example, your home that you purchase is worth $300,000 and your mortgage is, say, $240,000. That charge is a $240,000 charge and no more. With a conventional mortgage, the bank is only entitled to the amount you borrowed. So going back to that example of the $240,000, the bank is only entitled to that amount and they can't register any more charges to your name. The other benefit of having a conventional mortgage simply means that it's going to be easier for you to switch your mortgage at renewal date. You're not going to be incurring any extra costs to transfer to a new lender. Unlike a collateral charge, there may be some extra costs there that are required for you to switch from your current lender to your other lender at renewal time. So the negative of having a conventional standard charge mortgage is that it's a very simple mortgage in the fact that you can't borrow additional funds in the future without breaking that mortgage. So say you want to do renovations on your home or you want to invest in a real estate income property, then you're going to have to break that mortgage in order to access that equity that's in your home. So that pretty much sums it up for conventional mortgages. Now let's dive into collateral mortgages. A collateral mortgage is best defined as simply securing a mortgage or loan amount against your property. So unlike standard conventional mortgages, collateral charges are readvanceable. So what this means is, in the future, when you do want to borrow those funds for, say, renovations or that investment property, you don't have to break that mortgage. In the case where you do want to access that equity in your home, you can simply go back to the bank or the lender or your mortgage broker and simply request that you want an appraisal done on your property. And when that appraisal comes back and it is higher than what your original purchase price was for your home, then you can simply tap into that equity, usually up to 80% of the value, and you can use those funds to do as you please without having to break that mortgage. It also allows you the flexibility to register what is known as a home equity line of credit. So as you may know, a HELOC is basically a line of credit, but it's registered against your home, and you only pay the amount that you're borrowing. So for example, if you're taking out $10,000 to do some renovations, once you pay back that $10,000 and the line of credit is back at $0, you're not paying any interest on that. Most collateral charges can be registered up to 125% of your home value. So let's say your home is worth $500,000. You can register that collateral charge up to $625,000. Now, this doesn't mean that your mortgage amount is $625,000. Your mortgage is still your mortgage, only the collateral charge is the higher amount. So that's where you have the ability in the future. Say your home is worth $600,000 in 2 years from now, and you want to access some of that equity. Since it's within that $625,000 collateral charge, you can simply re-up on your mortgage and add that second component, or you can even add that HELOC as well, and that's the beauty of collateral charges. The downfall to collateral charges is it can be costly to switch lenders at renewal time. So a lot of lenders use collateral charges as sort of a retention tool to keep their customers. So for example, TD, they register all of their mortgages as collateral charges. So it makes it a little more tougher to switch lenders at renewal time. Now, it's not saying that you can't do it. It just simply means that there might be some more charges that are incurred at renewal time. The other downside, and something that people should be well aware of, is that lenders have the right of offset. So what this simply means is if you have a collateral charge, the lender has the right to collect the equity from your home on any financial products or anything that you've co-signed for that are now in default. Now, as scary as this sounds, I personally haven't seen this. It's not often that people default on their mortgage or any of their payments. So if you're someone that is good with your money and you're not missing payments on your credit cards or your car loans, then you should be fine with the collateral mortgage. Just keep that in mind that the lender does have more power in this sense. So to conclude, it's very important for you to understand the differences between the two and ultimately make that decision up front before you go ahead and register a mortgage. The bottom line is if you're someone who plans on tapping into that equity in the future, so if you're someone that plans on getting into real estate investing or you purchased a home that needs some fixing up, then a collateral charge might be right for you. As long as you don't miss payments and you're someone that's good with money, then that might be the right option for you. On the other hand, if you're someone that just kind of wants to set it and forget it and not tap into that equity in the future and you just want that mortgage, then a standard charge is right for you. So there you have it, guys. I hope that helped you make an informed decision on which mortgage route you should go in terms of a collateral versus a standard charge mortgage. So thanks again for tuning in, and I'll see you guys on the next one.